I'll start out on an inauspicious note by quoting Richard Nixon. Richard Nixon once said, "We are all Keynesians now." And in a similar fashion, we're all activists now. And that's some of the best news I think we have is an administration which is very deregulatory did not hesitate to throw $700 billion at this problem and will not hesitate to throw more money at it. So I think the odds of a depression or even a serious recession are much lower than most people estimate because the government is going to be activist, and I think we all think there are policy tools available to limit the downside to the bursting of the housing bubble. I'm going to kind of look forward and proceed down two tracks. One is to kind of quickly go over conventional regulatory solutions we might think about that would help us avoid a similar financial crisis in the future, and then talk about maybe a more radical solution we might think about. So the first conventional thing to think about is the incredible balkanization of the regulation of financial entities. You got the Federal Reserve, you got the control of the currency, and then you got the alphabet soup, the FDIC, the Commodity Futures Trading Commission, the Securities Exchange Commission. And that balkanization is a bad thing because you have different rules for entities which are essentially doing the same thing, and then you get kind of a race to the bottom that the regulators may start catering to industries, and investment entities will choose their regulator to minimize the amount of regulation they face. And you get more likelihood of capture of your regulator if you're small. It's much easier to capture the Commodities Future Trading Commission, which is small, than it is to capture the Fed, which is huge. And with the odds of that happening, I think, are small, Washington being Washington and fiefs being fiefs, but that would be a good place to start. If you had one global regulator, which would be the ultimate solution to that balkanization problem, the next nice thing would be common leverage rules. Banks came onto this relatively well compared to investment banks because they had capital requirements, and the amount of money they could borrow for each dollar they actually owned was, roughly a 9-to-1 ratio. The investment banks were leveraged twice as much as that. And for instance, some entities, hedge funds, and by the way, there's a great controversy over the origins of the term hedge fund, and it's important to understanding this debate. Most people think it means a hedge, as in reduction of risk. It's unclear. My view is the better understanding of the origin of that term. It is a hedge that keeps out regulators. The hedge funds were set up explicitly to fall outside the regulations of the SEC and the controller of the currency and the Federal Reserve. And so it was a hedge built to keep regulators out. And remember, the hedge funds are being very quiet right now. I would expect to see some news on that front over the next time. But the problem really began back in 1999 with long-term capital. I mean, it's kind of planted the seeds for what's going on. And their leverage ratios far exceed anything you found in even the investment banks. Third thing, and this is something Dick mentioned and John number one mentioned, transparency. And there's two forms of transparency. One is, and you probably heard this in relation to Bear Stearns, is counterparty risk. They were so scared of letting the investment banks fail because they have such a complex web of contracts with each other. And they're not done via an exchange like the New York Stock Exchange. They literally call each other up and sign individual contracts and do thousands a day, and you're a creditor on one and a debtor on another, and who the heck can figure out what all the balances are? And I think that was a valid concern. I think not saving Lehman Brothers was a big mistake. Maybe the regulator or regulators who come out of this mess should think about forcing all this stuff onto exchanges. If it's all on an exchange, there's one set of books, and it's much more transparent. The second dimension of transparency they might think of cleaning up is the so-called slicing and dicing of cash flows. So you've heard of these collateralized debt obligations where they take a pool of 10,000 mortgages, and instead of buying just a simple slice of it, you get the first $100 to come through or the last $100 to come through. And those slices and dices make it very difficult to figure out what in the heck these things are worth. And so the financial engineers have gone bananas with this stuff. It literally, and this is an industry which now employs hundreds, if not thousands, of PhD physicists to figure this stuff out. And maybe that needs to be regulated. Maybe there's just too much complexity for us. The unconventional solution, so that pretty much finishes up the conventional. The unconventional solution is motivated by the following thought. One, we want to economize on the number of our tax dollars ending up in the hands of people who have behaved rashly. And to a large extent, we will succeed with stockholders. James Coyne, who was chair of Bear Stearns, was worth about $2 billion 2 years ago. I know you won't feel bad for him, but he ended the game with about $25 million. And it was not clear he was going to be able to afford his penthouse place in the Plaza Hotel, right? So again, you're not crying for him, but people who see that will change their behavior. The creditors of Bear Stearns, who should have seen this coming, who lent them money at low rates so that Bear could invest in very speculative ventures, are going to come out of this with 100 cents on the dollar. That is not the proper incentives. That's the real, the so-called moral hazard you hear about when people talk about government saving these entities. So the focus should be on the creditor side. They should take a haircut. Now, how do you do that? If they take too much of a haircut and all the creditors of all these firms are paid zero, we'll get the Great Depression. That's precisely what we want to avoid. And the current legal procedures we have for driving these firms into bankruptcy, which is where they belong, would lead us there. It takes too long. The procedures are too convoluted in bankruptcy. And so an idea I'm toying with is a new bankruptcy section to deal with financial entities in distress, where the government basically comes in and says, creditors, you might come out of this okay, but you might not. We understand you have a credible threat against us because we can't let you go bankrupt. Or if we let you all go bankrupt, we'll get this sort of domino effect and a depression will follow. But we're not going to pay you 100 cents on the dollar. And so you'll get a little bit of a game of blind man's bluff, but the government should say, in effect, we're going to save 80% of you at 50 cents on the dollar. Who's willing? You might have to go up to 60. At some point, though, the creditors are going to start to panic, right? If the other guys start agreeing to take the haircut of this size, I might end up with the 20% that the government feels we can let 10 or 20% of the banks go bankrupt and it won't cause a depression. The possibilities for any of this, the possibilities of the final solution, by the way, is zero, right? The possibilities for more conventional regulatory relief, I would say, are small. I think this is going to be a shallow recession. I think 2 years from now, none of you are going to be thinking about this. You won't be calling your congressman. It'll be off the table. And so it may depend on the election. Obama's advisors tend to be more regulatory lot, and that could affect things. But my prediction is, in the end, 5 years from now, the law will not have changed. And so 10 years from now, we may be meeting in this room again.